presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Market Update for June the 13th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. I also do a weekly newsletter, one-pager that you can get. It's the Mo's Market Minute. We also do a daily broadcast, a podcast, where you can download that and listen to that. You can get all of this simply by going to compak.com/media. Right at the bottom right there on the page, you can see that. You can go there and you can subscribe to all of these services. They're all free. Where you get whenever I do a YouTube update, you'll get a notification, what I'm looking at, what I'm thinking about, show you the charts, why I'm looking at them, and so on. All of that is right here on the media page. I'm going to talk a little bit about the market, talk a little bit about the economy, take a look at the technical analysis and the week ahead. Let's start with the market. NASDAQ the S&P has entered a bull market since the 2022 low, which we were down to 3481 or so, 3,500 plus or minus, and everybody said, oh, that's the end of the world. It's going to 2,000, it's going to 2,200, it's going to 2,800. Everybody had all these numbers. You heard me say in October, I said, this is a fifth wave bottom. Looks like a bottom to me, and from here, I didn't know if that was a bottom, but looking at that in hindsight, within a couple of weeks, it was looking like a bottom. And then we start looking at targets on the upside. You heard me talk about the last 2-3 months. If we can get about 4,200 to 4,218, we could accelerate to 4325, which was the August high. Well, we've gone there and beyond right now. So where are we headed next? We'll talk about that. But the bear market, when you come up 20% off the lows, that is counted as a new bull market. So we've entered a new bull market according to the classic definition, but it's 20% late. You can look at property prices. They've come down more than 15% over the last 12 months. This is the commercial property index, and you can see that it has rolled over and it is in the negative. So it has come down a bit. I think it'll continue to put pressure on that. But as property prices, commercial property prices come down, real estate prices as a whole is coming down. When real estate comes down, that is rents come down. Well, we think rents, which I talked about last July when inflation hit 9.1%. You heard me say on this broadcast, I think we've reached a peak. And I showed you why. What were the things that were contributing to inflation? We thought inflation would be coming down. Well, today we got an inflation number. It's at 4%. It's down from 4.9 to 4% on a year-over-year basis. So we have cut inflation more in half. You heard all the gloomers and doomers out there that said, oh my God, the world is ending. No one was able to buy gasoline or food. They'll have a choice. Gas is so high, food is so high, all of that. Then everybody was talking about, just a couple of weeks ago, the debt ceiling. Oh my God, that's going to cause a crash in the market. Now we're hearing about everybody. Now it's something or the other all the time. Now everybody's starting to get a little bit too happy. They don't have anything to worry about as far as the market is concerned. That starts to worry me, and I'll tell you why. We've come up from 3,500 to 4,400 nearly, so we've gone up at nearly 900 points in the S&P. That's a big move from the October low to where we are right now. You can see all kinds of homes starting to come down. Inflation, we think, will continue to go down. I think it'll slow down, but it'll continue. The downward move will slow down, but rents, which are a big contributor, they don't go down. They are a much lagging indicator. As rents come down, that'll put even more downward pressure on the inflation market. We've seen all the money that was out there. That was 2.15 trillion. That was the amount that was sitting in people's bank accounts because they were unable to spend because of the pandemic. Well, most of that is down. We still have about 900 billion sitting out there, so we still have quite a bit of money, but from we've spent nearly 1.2 trillion is already spent. Household survey shows inflation expectations, well, they peaked again last year. They're coming down dramatically. 3-year inflation expectations, even lower. So everybody's looking for inflation to start coming down. Wages finally are starting to roll over, where wages have gone up dramatically and now they're starting to come down. We saw last week one of the highest weekly unemployment data. That means people applying for unemployment hit a 21-month high, which people are now starting to say, wait a minute, more people are starting to unemployment. That could tighten the unemployment market also. Remember, on the 27th of this month, today, I will be doing a seminar in Scottsdale, but you have to have a reservation. So go to compak.com/seminars right here. This is the website that you can go to and register. So compak.com/seminars is where you go and register, and it's all free, but you have to have a reservation if you want to come to the seminar. Let's take a quick look at the technicals. This was the high, the 43.25 number that I've talked about, the August high. Well, we exceeded it. Now we've left a gap today right here. Yesterday's high and today's low does not overlap. Is this an exhaustion gap? Well, I've talked about this gap right here. That was in March when we started this move right around 3,900. I said, is this a breakaway gap or an exhaustion gap? There's two kinds of gaps when you look at technicals. Remember when I used to teach this 30 years ago in the 90s, I used to talk about gaps, exhaustion gaps and breakaway gaps. Breakaway gaps are usually the beginning of a move. Exhaustion gaps are usually the end of a move. What happens there? Well, we go up, we sort of wiggle around here for a couple of days, and then gap lower, leaving this tiny gap right here, and that sort of leaves the market up here for 2 or 3 days, and that is called an island top. Haven't seen that yet, doesn't mean we're going to be there, but I'm also looking at a fifth wave in the market right here. I was looking at this high as a target, 43.25. Today we closed at 43.69. This is this line right here, this right here, 4,400 to about 44.50. These two lines right here, this line. This is a projection from here, from this high, 43.25, we get this projection. And that projection is at 4,400 to 43.20, 44 to 44.50. If we are at 43.69, if we go up there in the next couple of days, touch it, turn back down, and leave this as a gap or an island top, that would be negative for the market. So that's the way I'm looking at it. Also, when you see a fifth wave, this was a fifth wave top. From 4,300, we went down to 3,500. Doesn't mean we're going to see the same thing today, but next support now is at 42.41, 41.63. As you know, I'm sounding a little bearish, even though everybody is all excited right now. I think we've come up quite a bit. We're in the seasonal week time frame. We've come up a lot. All the good news is out there. The Fed is going to hopefully pause tomorrow. If they do, that could be bullish for the market. Today we saw inflation. All the good news is already there. So now all the people that sold here and bought here somewhere, they always buy the tops and sell the bottoms because they make emotional decisions. Well, I think those people have got to get a little correction down to 4,200, maybe even 4,200, a couple of hundred points down. That'll wipe out again all the people that are bought again, that buy the highs, that sell the lows. They continue to do that. We are a little bit overextended in the market. So we'll see. We could continue going straight up. The markets have a way of fooling most of the people most of the time. We continue to go higher. Markets go beyond what is reasonable. On the downside, they can't go lower, but they do. On the upside, they can't go higher, but they do. So let the market do what it is doing. Just keep yourself out, have a good diversified portfolio with the right risk number, with the right risk allocation, with the right financial planning, and let it go. Don't try to beat the market. Don't try to outsmart the market. You're not that smart. No one is. So that's, as long as you know that, you'll be okay. 4,200 on the weeklies is also good support. We exceeded that, and now we've exceeded this August high from last year. Next resistance is right about here, which is 4,600. And if we've started a new wave count weekly, this is a weekly chart, so each bar is 1 week. If this is wave 1, this is wave 2, this is the wave 3 target, is somewhere around here. And that's right around 4,800. That was the previous high in the market. NASDAQ also targets 13,650 to 14,000. Closed at 13,573 today, 75 points off that high. This also looks like a 1, 2, 3, 4. This looks like a fifth wave top. Support now 13,000, 12,464, and 11,5. If we hit 14, come back to 13, maybe even 12.5 over the next couple of months, buying opportunity. But again, looking like a fifth wave top. Whenever we see 5, that usually means either an ABC correction like this, A, B, C, or we start wave counts to the upside or the downside. So we're stretched again, 14,000, 13,650 to 14,000 is the target. We're within 75 points of that on the S&P. Weekly charts, we turn positive. This is my dot plot. When the market is above, this is the market, these vertical lines. When the market is above these dot plots, it's positive. As you can see, it turned higher in February, and we've been higher ever since. So that's usually a good sign for the market. 10-year note interest rates resistance here, which is about 4%. Just going back and forth. I think we could get a little bit more bounce here. Gold market continue to drift lower. This was the high, 2085. If we break 1931, which is this low right here, last month's low, then about 1850, that's the 200-day, to about 1900. Somewhere in that vicinity is where gold could go. So I'm not particularly excited about gold. Today we should have had a good day and the gold market did not. Those are my views. Those are my thoughts. That's what I think is going to happen. Stay tuned. Now I'll be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.